Welcome to a video in which I'm going to be explaining how my lifetime hourly averaging tax system and benefit scheme would work. And it's something that I think will be a useful thing to talk people through it. And that's not necessarily because it's a hugely complicated way of working out people's taxes. I think once you get used to thinking in this way, it seems perfectly obvious and easy to understand. But I do think it takes some explaining because it's just a completely different way than we're used to of thinking about how tax should work, how to calculate who should get what out of society. And the maths isn't anything too complicated. It's averaging, so it's just dividing, multiplying, a bit of addition and subtraction in there. I'm not a mathematician and I invented the thing, so there's nothing too daunting about that. But yeah, people sort of get ideas in their head about what lifetime averaging might mean, what lifetime hourly averaging might mean, and their first thought pretty much always seems to be wrong. So I'll try and give this explainer and help people to understand. So I'll start us off by talking about lifetime averaging. So we'll postpone discussion of my hourly proposal for now and just focus on the lifetime aspect. Lifetime averaging is a proposal that's not unique to me. I had this idea for hourly averaging, and then later on I looked at the literature, and it turned out that lifetime averaging was proposed by the quite famous economist William Vickrey, and he wrote about it in the 1930s and 40s. I think we can do it much more easily now with our technology that we've got compared to the way that he was envisaging it with the technology at that time. But so I'll start out talking about lifetime averaging, and then I'll go on to my hourly version. And I'll start out by saying some of the things that lifetime averaging isn't, because sometimes when I've said to people, oh, I've got this lifetime tax scheme, and then they think it's something and it really isn't that. So I'll say the things it isn't first, just to get these out of your mind if you're thinking along these lines. One thought might be, oh, this means that you have to wait until people die before you take any taxes off them. And so I want to say straight away, absolutely, that's not what I'm proposing here at all. That wouldn't be sensible, and you don't need to do that with a lifetime averaging system. And another thing it isn't is some sort of lifetime cumulative system where you just look at people's total amount of earnings and apply a tax rate on that. You could do that. That's been proposed. Basically, it means you tax younger people less and older people more. I don't really see that that's hugely advantageous to do, and that's not what I'm proposing anyway. So ignore that. What I'm talking about here is an averaging tax scheme, and so the basic point is that what we should be focused on is the person's average over time, and not just total income. At the moment, we focus on the income that people have in each year of their life separately. Well, this is looking at their income over a longer time period, but you're dividing it by something to get an average. And so for lifetime averaging of this kind, what you're just dividing by time. So you take the person's income up to this point, as long as they've been in this tax scheme, so maybe since they were 16 or 18 or whatever it is in this society, and then you divide it by the amount of time that they've been in this averaging scheme. So that's, for Vickrey, that was years, but it could be months or even weeks. This is just averaging by the amount of time that's passed. So it doesn't really matter. And then when you do this division, this tells you the gross average for this taxpayer over their whole lifetime. And then it's on this that you look at the tax graph or the tax equation, whatever it is, and you work out what their tax rate is based on this average, and that's what you use. So rather than looking at their gross income per year at the moment, you look at their average gross income across their lifetime to work out their tax rate, which should be applied for their whole lifetime. And I'll talk about how to do that shortly. But for now, this calculation, what we're doing is we're getting the person's lifetime average. We've got our tax percent. If their tax rate is 50%, then half of their lifetime gross income should go to the tax authority, and half of it should go to themselves as net income. So you work this out on, you can work this out for the average. It's 50% for the average, and then you can apply that to the total. So if you work it out on the average, then what you would do is just multiply each of these two, each of the tax and the net income, back by the amount of time, and that gives you their lifetime total net income that they should have received up to this point, and their lifetime total tax that they should have paid to the tax authority at this point in time. Okay, so how does this work? And that's that equation there. How does this work then in practice? That was a fairly abstract overview of it. So let's think about what the government could do to collect this tax. And as I said, there's different ways you could do it. Vickrey suggested one way with annual tables that would differ for different people. But I think that we've got real-time taxation now, and that is definitely the way I think we should go with an averaging system like this. And so what you would do is you would want to withhold people's tax. That's always a good idea at every opportunity. So what we do in the UK, we've got our PAYE system. When someone's getting paid, the tax system the tax authority has told the employer, well, how much do you get, and how much do we, the tax authority, get? They do that through tax codes, but you can do this in a real-time basis as well, as is increasingly being done, where the employer would just ask the tax authority, we're going to pay this person this much, how much should we give to them, and how much should we give to you, the tax authority? So everyone gets the right amount of income and pays the right amount of tax at every opportunity. So it's being withheld in real time. So what this there's an extra step in this when you're doing it as a lifetime basis, but it's nothing too complicated. So all you do is you treat the current point in time as if it is that person's sort of end of lifetime. So you do this at every point, and then when something changes, you just recalculate it again. So you're just constantly recalculating this person's lifetime totals. When they get some new income or a new amount of time has passed, you redo the calculation and you say, okay, now we know how much the person should have received at this point in time and how much should have gone to the tax authority. So it gives us the new lifetime amounts. So we know their new lifetime gross income, and then we can recalculate their lifetime tax that they should have paid and their lifetime net income that they should have received for themselves, for their own purposes. And then what we do, or what the government does, is to say, well, okay, well, you've already paid this much tax up to your last payment, the one that we've just had. So we look at how much we've received up to now, and we say, well, that's already been paid, so what's the difference? And that difference is the amount that the person should pay in tax at this point in time. Or you look at it the other way around and you say, the difference in what they should have got according to their new lifetime totals, you take off what they have received before, and that's the amount that they should get now. So you're just recalculating it every so often, or every time they get some new income. And effectively, you just, at every step and every time you do this, you're ensuring that the person is getting the right amount of income. You're ensuring that the government is getting the right amount, and so it just continues on this basis throughout time. So as I say, tax averaging is a long-standing proposal. I think it would be easier for us now with our contemporary technology than it would have been in previous times. And my innovation, though, is not just that we can use technology to do it better, but also that we should do it in a different way than it's been considered by other people. And I refer to this as hourly averaging. So this is my innovation here. And the idea is that we're not just looking at the amount of time that has passed. I suppose you could do that by the hour, just for each taxpayer. My proposal is that you should only do it by hours of a certain quality, and primarily for our purposes for this introduction, we'll just say it's averaging by the amount of time that people are working, and what you would do is average by what I'm referring to as hour credits. So when someone does an hour of work, their employer informs the tax authority, just like they inform them of how much pay they're getting, and they tell them this worker has worked so many hours this month or week or whatever it is, and then this is used in the person's averaging calculation. So instead of just simply dividing by the amount of time that's passed, instead you're dividing their lifetime income by these hour credits that they're building up in their tax account. And so what this gives then is a lifetime hourly average for the person. And it's this hourly average on which people's tax rates would then be calculated. So as I say, for each hour worked, but actually maybe if I get time I'll do another video where I talk about the other ways people would get hour credits as well as just working for an hour. But for us for now, this is the main point anyway. When people do an hour of work, they get hour credits for them, and it's these that are used to work out people's tax rates. And I should flag up as well that I'm proposing basically to replace the income tax system and maybe some other taxes as well, maybe even all taxes, with this hourly averaging system of taxation. But actually, I think it's very powerful as well to use as a a replacement for a lot of the help that's given to people who are among the less economically well off, and certainly it would replace tax credits. In fact, it's a much better form of tax credits, I think. You don't need to even refer to it as tax credits. It's just basically a negative tax rate for people with a low hourly average. So that leads me on to talk about the sort of tax rates that I think should be applied. You would only do this in order to be able to have a much more progressive system of taxation than we currently have. That's the ultimate point of this. It's a way to have just much more progressive taxation than would be possible with any other scheme that I think you could propose that wouldn't hugely violate people's privacy or liberty or anything like that. So this is the sort of graph that I think you would end up with. It's just a vague, sort of curve that has the sort of features that I would expect to see in a tax rate with an hourly averaging scheme. You'd want it to be a very progressive rate like this. If you didn't want progressive taxation, then you wouldn't bother with this kind of scheme. So I think we should have very progressive taxation. And you'll notice here in this bottom area, we've got, for very low earners, as I was saying, negative tax rates. And so people with very low lifetime hourly income averages, they would get, for every hour that they work, they would get a top up on their income. So this is a way to support the low earners and do it in a much more generous way than you can do with other forms of system. And you're still encouraging them to work because they get it for every hour that they work. So it can be quite generous to the badly off without giving them an incentive not to work. So it rises quite steeply for this in this lower area, and then I think it would probably level out a bit here. It would never go down, so that's a bit silly. It would go up much more slowly in this point here, where it's crossing the zero, and then it would rise much more steeply for the sort of middle and upper earners, and then it would start to level out, and it would end up just being a straight line at some point. It just goes on straight in this way. And one of the features that you would want this tax rate to meet certain constraints, and one of them is that you would never want it to get to 100%. So that's not a straight line, but it's about as good as I'm going to do with this mouse. Maybe this could level out at 99%. Maybe it could level at 99.999%. But the point is, it should never get to 100%, because you always want, one of the things that you want from this tax rate graph, which would be represented by an equation, you would always want it to be giving people more net income whenever they get gross income. If the tax system means that if someone gets more income, then they actually have to pay more in tax than they got, then that wouldn't be a very good system. So that's one of the things. It wouldn't ever get to 100%, but it would be very progressive in these ways. So maybe let's think about Jeff Bezos. If he cashed in his shares in Amazon and whatever investments he's got and put them for his own use, he would be somewhere way up here at the top here. So when you divide his massive income that he's just got by the number of hours he's worked. You know, he's a hard-working guy, I'm sure, but he hasn't worked that many hours more than a regular worker, like someone who's much further down on this on this graph. So then at this point, his hourly average is absolutely huge. And so you can say, well, people with these really huge hourly averages, they get taxed at 99%. So you can't have that kind of rate of tax, I don't think, in a sensible tax system unless it's done on this lifetime basis, unless it's based on averages. So that's a little bit about the tax rate and how it can be and it should be very progressive. And the point of it is that you can be much more progressive with an hourly averaging system. Okay, and then how does this look when we just compare the gross income per hour that people get with their net income per hour? So these are two different kinds of tax rate graphs that you could apply. The one that I showed you, that would look more like this one on the right hand side here, because it's got a kink in it, whereas the one on the left hand side is just a fairly straight line graph that wouldn't have this kink that I've put in here. So for people who are around that sort of 0 point up to, you know, a little bit above that, their income net is going up fairly roughly in line with their income gross. But people who are earning very low amounts, their income isn't going up quite so quickly when they get extra income. And then again, that sort of thing is applying for people further up as well. And so what it's doing is it's effectively pushing down the average income of, well, it's taxing, so it's generating tax revenue from the higher earners who are providing a lot of tax revenue at the moment, but on this scheme would provide more. It's pushing their net income much closer to the net income of the worst off, compared to where they would be on their gross income differences. So it's pushing people's hourly incomes, oh that's terrible, pushing them closer together on this net axis compared to the gross axis. So that's what it's doing. It's in one way you could look at it is to say it's getting people's hourly pay closer together. Okay, so let's think about how the taxpayer themselves is going to look at things under this hourly averaging system. So their tax rate is going to be worked out, and it's going to vary based on not just their gross income, like would usually be the case with any other tax system, but their gross income and the number of hour credits that they've got, and it's a complex mixture of the two. And this is what determines their income that they get out of society. It's a mixture of these two things. So one of them on its own doesn't determine how much they get. It's based on the joining of the two. So you've got you could just have an hour credits based system and just say, well, everyone gets exactly the same per hour credit, and then you wouldn't get some of the incentives that you get for people to earn more money that you want to keep, but you don't. Well, this is what we've got is a sort of just a purely income based system, and with this hourly averaging, you can be much more progressive with your taxation. So, so when people get more income after they've been in this scheme for a while, then they're going to get used to the tax rate is going to stabilize, assuming their circumstances don't change hugely, and they're going to get, a certain tax rate based on their historic averages, and people are just going to get used to the fact that when they get more income, they're going to get that percentage of it. Whether maybe they pay 25% tax rate, so they know if they earn a certain amount of money, they get 75% of it, and the tax authority gets the other 25%. So that's going to be a personal thing for each person based on their personal circumstances. It's not just something that applies to all forms of income, irrespective of who gets it. It's much more personalised, and I think that's a big advantage, because then you're taking account of that person's economic circumstances. So they get used to the amount that they get from income. A certain percentage of that will be what they get. They would also recognise after a while that when they get an extra hour credit, that just has a certain value to them as well. So maybe, Jeff Bezos's hour credits, when he gets them, they're worth, well, maybe more than everyone else's, but not hugely more like he gets at the moment. But his are worth a certain amount. Everyone just gets used to the fact that their hour credits effectively indicate that they're going to get a certain amount of money. I get an hour credit, that means I'll get £10 of income, $10 of income, whatever the currency it is. So once your tax calculation stabilizes, you just start to see it in that sort of way. You don't look at taxation in the way that you would under our current system. And our credits are going to be highly desirable to people because, as well as just releasing money immediately when you get one, or however many you get, they also are acting to reduce your lifetime average in your calculation. So they're acting to bring down your average at the same time that your extra income is acting to push it up. So if you're very regular in your earnings, very stable in your earnings, then those two are just going to even out all the time. But the hour credits could actually bring down your lifetime average. And then when that happens, what happens is that effectively you get released to you some of the income that you've paid in tax previously, because it's reducing your lifetime tax rate over your whole life. So then that small reduction in your lifetime tax rate means that you've sort of effectively overpaid in the past, so you get a bit back now. So our credits become very valuable to people. And the system as a whole is set up so that people have always got an incentive to earn more money. That's a useful feature of the economy. You want people to want to earn more money. That's been long recognised as a worry about benefits and the poverty trap and so on. If people's effective tax rate is above 100%, that actually means that they're better off not working more. This system would be set up to ensure that whenever you get more income, you'll get, whenever you increase your gross income, you'll always get some net income. Now, you might only get 1% of that increase, but you'll get something. So that it's always beneficial to you to get more income, and for most people it will be much more than 1%, but at the extreme, you'll always get something anyway. And there's also this incentive built in for people to work more hours, and that's an important thing as well. We want the economy to be effective, we want people to make use of their time and to contribute, and so that's another good feature of this system, that you can have these very progressive tax rates by making the tax rate personalised to that person. but you still got an incentive for them to work because hour credits are such a useful thing for them in the way that they effectively release money to the person who gets them. I do propose a maximum amount of hour credits that people should be able to get, per month or however long the period is. And there's several reasons for that, about not encouraging people to overwork and not to limit the scope for people to have fraud in the number of hours. But at least up to this maximum, people have got an incentive to work more hours. Okay, so then why bother going to all this trouble of scrapping the current system, which has been creaking along for such a long time, and to put into place an alternative which admittedly is a bit more complex. It would be something that people would need to take a bit of time to understand and that sort of thing, and it would be slightly more complicated for the government to administer as well. And certainly in the short term, switching systems is a very complex thing. So why would you go to all this trouble? So I'll just summarize this. So as I say, it enables you to have this much more accurate, personalized tax rate for everyone in society, and this tax rate would be just much more tailored to their economic success than is the case under any other tax proposal. And that means, along with other features, that you can be much more progressive in your tax rates. You can go from negative 1,000% for the badly off, all the way up to 99.9% for the really well off, and you're just really bringing everyone's income just much closer together. You're generating tax revenues from the best off people much more than you can under other systems, and then that means you can be more generous to the people much lower down the scale. And I've said a bit about how people have an incentive to get more income, which is good. People have an incentive to gain more hour credits, which means they have an incentive to work more hours. And so this is still encouraging the economic efficiency. And in my introductory video, I pointed out that what we want in a tax system is progressivity, and we want efficiency. And that usually people would see these two as being opposing things. That the more progressive we make the tax rates, the less efficient the economy will be. Well, this is a system that gets us out of that dilemma because it's got this personalized lifetime average tax rate, which retains these incentives for the work and the and earning more money and working more hours. So I really hope that was a useful explainer to the system. It was a bit abstract, so I'm going to have another video now where I'm going to the next one I just go through some examples. So these two videos will complement each other. Maybe that will help illustrate what I've been talking about here. Maybe this has been enough for you and you don't need the examples, or maybe some people will just need the examples. I don't know. But I hope this has been useful and has led you to understand how it works and what the advantages are. And do get in touch with me. Leave a comment or whatever it is to suggest ways that I could explain this better. If you think I should have another go at explaining it, the things that helped you understand it, the things that made it harder to understand, any thoughts you have, do get in touch. And so I hope this has been useful. And yeah, thanks very much for for taking the time to listen and try and understand how my lifetime hourly averaging scheme would work.